Samir, as much as you read...
Just one line. Bharat was junior to me by 1 year at IMC. That's why he's so smart.
I didn't know that.
And Samir was called junior in the institute.
You have a common thread. That is good. Samir, as much as you read books, do you also watch movies or you don't?
I do watch movies.
So if you've seen the movie Pushpa, I'm assuming you
No,
have.
I haven't seen that because I was away for many months. But
Okay, so I'm not giving you the story, but when you spoke about these multi-baggers, and even Bharat Bhai also rightly articulated, again in that same movie, that's the recent movie I've seen. So where with those
okay, I'll see it. It's on Amazon Prime, I think, right?
Yeah, it's on Prime. So in that again, there's a dialogue which says that Pushpa naam sunkar flower samjhi kya fire hai main. So effectively, that is what it means, that multi-baggers, Midas tak sunke multi-bagger samjhi kya, aisa nahi hota hai. So I think that's what the viewers need to keep in mind, and that's the messaging which Samir is trying to give us right now.
Welcome again, ladies and gentlemen. Midas touch really means the ability to make money out of anything one undertakes. Ladies and gentlemen, the next panel consists of the most revered thought leaders of the asset management industry in India who are perceived to have the Midas touch. The panelists are Mr. Bharat Shah, Mr. Rajesh Kothari, and Mr. Samir Arora. And ladies and gentlemen, Ms. Lakshmi Iyer is going to be the moderator for this session. Now, let me take a moment to introduce our panelists to you. Mr. Bharat Shah is the Executive Director of ASK Group. He's a qualified rank-holding chartered accountant, cost accountant, and MBA in finance from IIM, Calcutta, having topped the class in finance. He has over 30 years of experience in the Indian capital markets with deep interface in Indian corporate world, and he represents comprehensive insights in Indian capital markets with strong emphasis on bottom-up investment philosophy. He has considerable understanding of global businesses, and stock picking is his special strength. The investment philosophy emphasizes buying only quality businesses enjoying superior growth, but at reasonable valuations. We have with us Mr. Rajesh Kothadi, the founder and managing director of Alpha Accurate Advisors. He is the visionary behind the customer-driven and excellence-based approach, a CWA and an MBA by qualification. He has a rich experience of more than 20 years in the Indian capital markets and has handled several investment projects in premier investment institutions. During his tenure as a fund manager at DSP Merrill Lynch Fund Managers, the equity assets under management flourished from US dollars 100 million to US dollars 1.5 billion. All through this period of 5 years, ladies and gentlemen, the equity schemes often ranked in its first quartile ranking by CRISIL. We have with us Mr. Samir Arora, the main founder and fund manager at Helios Capital. From 1998 to 2003, he was the head of Asian emerging markets at Alliance Capital Management in Singapore. And in 2002, he was voted as the most astute equity investor in Singapore in a poll conducted by the Asset magazine. And more recently, Helios Strategic Fund has been nominated for the Best India Fund by Eureka Hedge 10 times and has won the award 4 times. Helios Strategic Fund has also received the Asia Hedge Award 2018 for its long-term performance. And this session will be moderated by Ms. Lakshmi Iyer, who heads the fixed income and products team at Kotak Mahindra AMC. She has been with the organization for the last 20 years and is responsible for credit research, deal execution, managing fund performance across all debt funds, and assisting sales in client interaction. In addition to that, she has been a portfolio specialist and managed product-related initiatives such as product pricing and coordination with the fund's management and sales team in that role. She holds an MBA degree in finance from NMIMS, and she loves exploring new places for traveling, is a big food lover, and is an ardent movie buff. Ladies and gentlemen, once again, I extend a warm welcome to our panelists, Mr. Bharat Shah, Mr. Rajesh Kothari, Mr. Samir Arora, and our moderator, Ms. Lakshmi Iyer. And now it's over to you, Ms. Iyer.
And if I can add, Lakshmi wears a 20-year experience quite easily on a younger-looking face.
Thank you, Bharat Bhai. Hi, Aishwarya. Thank you so much for this. Thanks, Kamal, and the entire team at PMS AIF World. And a very good afternoon to all the viewers today. We have hopefully a next I would say, Gyan-packed session over the next 40-45 minutes. As what we are seeing here today is pretty much similar to what we see in Allahabad as a Triveni Sangam. We are seeing three stalwarts in their respective fields who have very, very diverse traits as money managers, very distinctly different from each other. And yes, they're all three of them here together. In this Gyan Sangam, and I will try to see how best this confluence can be explored and exploited. I will wear the movie hat in me first before I wear the money hat, because the topic for today is a very interesting one, that of the Midas touch of money managers. The fallout is very different: richer, happier, wiser. It's a very relative concept. So that will follow after 45 minutes, hopefully. But let me wear the movie hat before I wear the money hat, because this topic actually reminds me of this very interesting dialogue in the movie Pushpa. I'm sure quite a few of you would have seen it. And for those who haven't, just see it for some masala. It's the latest Midas touch by Allu Arjun, which has just crossed 100 crores in just 7 weeks. And there is this interesting dialogue in that which says that नाव में बैठकर जल फेंकना बहुत आसान है, पर पानी में उतरेगा तो बड़ी मछलियां खा जाएगी. And that dialogue is so relevant in today's times, where everyone thinks he or she is a money manager, or everyone thinks that पैसे बनाना बहुत आसान है. And I would say in my own, and now I will bring in the food part of my liking, where I was trying to see that, let me Google up and see how to really tone down, how to really try to have a diet restriction and stuff like that. I thought it was easy. To pay money felt no way breezy, till I met my friendly neighbor who said, believe in someone's labor. That for me was the Midas moment, no reason whatsoever to lament. So I think one cannot undermine the importance of having a money manager's role to make your life, your investment life, much more prosperous. And I think that's why we have, all three of them today to share their insights. So Bharat, I want to start with you first. What does it really take to create this Midas touch in one's portfolio?
I think Midas touch is like a bit of a dramatized statement. I would say creating wealth out of income and creating wealth out of the wealth probably is the specialized strength that a good investor has to bring on the table. And that indeed is the purpose of good investing. A lot of people are good at creating high incomes. I mean, a lot of professionals, senior executives, many of them make and earn very high income. But not too many of them probably are good at converting that income into wealth. A lot of entrepreneurs, talented individuals are good at building businesses and wealth out of that. But their ability to create wealth out of the wealth and to compound it really is a challenge for many of them. Therefore, the special, I think, strength that you bring on the table as an investor, as a conscientious investor, is the ability to compound. An ability to compound is something which is underrated, because compounding is a series of small, effective, efficient, disciplined steps over a long period of time, such that in each individual step in itself may look irrelevant or minor, but the culmination of those series of steps is nothing short of being dramatic. It is small individual step resulting into a momentous journey. That is what compounding is all about. And it looks innocuous in itself. It looks almost irrelevant in itself, because each individual step probably will not make anything dramatic statement or a meaningful kind of a likely outcome. But the trick is doing it systematically in a disciplined way over a long period of time. And each step itself is effective, even if it is small and minor in its appearance. Uh, that calls for understanding that. That also calls for discipline. And that also calls for patience. And none of those are easy. Long term doesn't come easily to people. Patience doesn't come easily to most people. Understanding that process requires a kind of a thought process, which either you have it or you don't have it, or you develop it or you don't develop it. And therefore, none of that, while it is simplicity in itself, like we always say for investing, it is simple, but never easy. And therefore, it is ability to compound, ability to do it relentlessly, ability to understand that markets are volatile, have always been volatile over centuries, and will remain volatile over the coming centuries and coming decades and coming years. And that volatility is not a threat, it is an opportunity if you know how to use it to your advantage. And therefore, the moment you realize that volatility is a character of the markets and is not a threat actually, if you know what to do with it, then I think the whole perspective changes. That makes you more long term. That probably makes you less reactive. That allows you to be more responsive rather than being fickle, judgmental in the approach. And that is something very, very important in order to build wealth. What you describe as Midas touch, as I said, is a bit of a so to say loaded and nuanced kind of a phrase. But I would say it is essence is ability to not get deterred by the machinations of the market. Markets are not designed to make you succeed. It's your duty to make success out of the markets and its violence and occasional adrenaline driven joys that it throws your way. Neither too much of joy that markets throw up is something necessarily in your interest at a point of time, nor the kind of pain and agony that markets time to time give you really are points to be concerned about or to be worried about. Each of these requires you to be like a bystander as an observer. That this is a reality which plays out all the time without getting impacted and affected. You play the role of a player, and to that extent, emotionality of markets does influence you. But at the same time, it is important for you to be a bystander so that you retain a detached perspective. I think it is ability to combine all of these and not falling for the booby traps that markets throw your way, to do your karma with discipline, with a longevity, with long-term view, and exercising the the prevalence, the salience of wisdom over too much of smartness and intellect that we try to display, because markets are never shorn of intelligence. But trying to display it or trying to play it out too much of it probably is hurtful rather than gainful. And that is what I think the wisdom hopefully teaches you over a period of time. I would say it is collectively many of these things together, which makes it look as if it is a huge outcome over a period of time. But it is something which is logically built. And to that extent, building wealth, I would say, is not an accident, is not a chance. Of course, any investing exercise, there is some level of chance. There is some level of happenstance, but larger part of the design, larger part of the outcome, the longevity of the outcome over a period of time is rarely a happenstance or a chance. It is actually something which is a design. And I think building wealth, making it work, doing it systematically is not a matter of chance. It is something that is a skill that you develop.
No, I fully agree with you. But in fact, for all you viewers here, I'm sure you got your anecdote. That if you really want to persevere, if you really want to progress in the path of wealth creation, you have no choice but to be disciplined. So, again, since the topic is Midas, Samir, Midas was the king, they say, who actually possessed the art of the old. Because you may have many such moments, but what is that one Midas touch that you identify yourself with? I mean, there would be many, you can mention probably a couple of them, but that one thing which really stood apart for you.
So I don't exactly understand the intent of the question in that sense, that what specifically happened. But the thing is that, this is a business or a job or work that at least we, Bharat and all of these enjoy, because it's not only that you are creating wealth for others or whatever, but that way it is done while reading and while engaging with CEOs of companies and analysts, and it attracts the smartest guys because it is a money business. And if you can do well, you can do really well. So in that sense, there's been a continuous thing. But if you say, what did I learn which has helped me do well? So one thing I would say is that not to overcommit to anything. So the idea is that to go into any business or any company, or to believe that you have discovered a gold mine and therefore this stock has to be held for 10 years and 20 years upfront, is something that, we in the 90s, when we were starting out reading all these Warren Buffett books and seeing that you hold things for the long term, what I realized is that it is beyond the capability of even the company managers or owners to know how their own business will do over time. So we have done well by saying that we are long-term investors, but we will look at long-term in increments of 1 to 3 years at a time. And that gives you the flexibility that if you are wrong, to not have overly committed to yourself and to the world and to the investors, and I buy only for the long term. But what happens if in 1 year you really want to change your view, either because of company factors or some other companies doing better or whatever, and tying yourself in knots? But I didn't exactly get the tone of what you wanted to say. But for me, the thing is, long term is a series of 1 to 3 year short terms, because that is the horizon which you can analyze in terms of context of that day's environment, the strategy of the current management, the current government or interest rates or policies. And then if it does well, you continue to do well. But you don't go in saying that long term means that every stock I buy, I have to buy it for 20 years, because my ego will be hurt that I did not choose a correct stock on day one.
So, Samir, my question was more in the sense that, you, of course, have the knack of identifying sectors, themes, stocks. So, without really getting specifics into stocks, my question to you was, what is that one high point, where you really thought that, this is what I touched, and it actually, lo and behold, shown into gold. So what was that moment? And of course, as I said, as an investor,
no, I know nobody feels like that, because none of the stocks that you buy on day one, you feel that this is your retirement stock. Actually, I have had nearly all these multi-baggers, but I have never started them by thinking that this is to be 7% of my fund, because this is it. Actually, there's only one stock where I've ever felt in 25 years that I should resign and join that company and sell that company's story to the world, which was in 1998 Z. Okay, at that time it was competing with Doordarshan, and I said there's no analysis required, because from tomorrow nobody's going to watch Doordarshan, because they had a certain programming sort of timetable, and you said broadly nothing else has to be done. And then the stock was not going up. Its market cap was $50 million, and we had bought 10% of the company for $5 million. And I used to think that I should leave my alliance job and join Z and, sort of do that or whatever. But otherwise that, whether it's Bajaj Finance or HDFC Bank or Kotak Bank or all of these we have had, and big way. But the point is, never do you feel on day one, oh, this is supposed to be 100 bagger or something. You are saying that for the next 2-3 years, it'll give you some 8-10% higher than the market, which we consider as a very good starting for some of them, which would mean for a new discovery that maybe it should go up 25% per annum for a few years, and then we see how it goes. But if I read this book Noise by Daniel Kahneman, the point is that what happens in the end is not because you identified it or something. So let me put it in our context. So let us say I bought HDFC Bank. I have it from the IPO days. But what if Aditya Puri had been fired for having an affair with his girlfriend or with his secretary? The point is, things that take you to be successful in the end
That's true.
have nothing. You can't plan and say, oh, because Aditya Puri was so good, because the fact that he was in the job for so many years itself needed many factors of luck and this thing. So the point is, you are what Bharat saying is perfectly right, which I say in a different way because I say it more colorfully. I say that's like a casino, that we want to be the casino and not the bettor. So what happens there is that the casino has a slight advantage over the guy who's coming in to bet, which is a very small statistical bet. And we also have that in some sense by saying we look at valuation, let's say. Simple, I'm not even saying some complicated stuff. Or we look at some history of the company or management or whatever. So you have a small advantage over the market, which is the unmanaged market, you can say, or the index or whatever. And that small advantage you have to capitalize. So to capitalize on that small advantage, you must put a slightly larger number of bets on the table so that the stats come through and not luck. That I bought a stock and something went wrong in that company, and whatever be my analysis went for a 6 because I then acted like as if I was betting in the casino rather than being the casino. So having these 30, 40 stocks and having some advantage of that company over the market, in the end it may turn out to be wrong because some other factor change it or whatever, is the reason why I think that the consistency of our performance has been good.
Yeah. Sorry, Bharat, you want to say something? Hanji.
Yeah, I wanted to echo the part of what Samir was saying. Often enough, unless we want to be arrogant about it, we talk about multi-baggers and some of the successful, really large ones, we want to wear as a badge of honor. But I echo part of what Samir said. Multi-baggers in some sense happen. It's not that you entirely predict them. You may have a sense of, a general sense of an opportunity when you engage into it, that it is a kind of a superior business, that the people behind the business are the kind of people that you relate to, that it is meaningful engine to compound and grow, and maybe some sense of valuation where you think there is an opportunity. But I think to be able to say that right at the beginning you predicted Infosys that it will happen, that Infosys in our portfolio at one time went up some 150 times.
Yeah.
Or Bajaj Finance over last 11 or 12 years is about 220 times. Did you predict that it will happen? You certainly did not, at least I did not. I think it is the patience, not getting distracted, and generally, which is why I used that phrase earlier, over usage of intellect is actually harmful, and wisdom is actually far more useful trait to have. And therefore, if we are just able to be patient and little more benevolent for a good opportunity rather than reactive, then I think chances of many of those turning into multi-baggers is higher. Rather than prescient laser-like vision right at the beginning that something will become 50 times or 100 times, that's an over-indulgence for our own self, rarely a reality.
No, absolutely correct. No, I completely echo both your thoughts. Samir, as much as you read...
Just one line. Bharat was junior to me by 1 year at IMC. That's why he's so smart.
I didn't know that.
And Samir was called junior in the institute.
You have a common
Still,
thread. That is good. Samir, as much as you read books, do you also watch movies or you don't?
I do watch
So
movies.
if you've seen the movie Pushpa, I'm assuming
No,
you
I haven't
have.
seen that because I was away for many months. But
Okay, so
uh,
let me, I'm not giving you the story, but when you spoke about these multi-baggers, and even Bharat Bhai also rightly articulated, again, in that same movie, that's the recent movie I've seen. So bear with
it's
those
okay. I'll
examples.
see it. It's on Amazon Prime, I think, right?
Yeah,
Yeah.
it's on Prime. So in that again, there's a dialogue which says that Pushpa naam sunkar flower samjhi kya fire hai main. So effectively, that is what it means, that multi baggers Midas tak सुन के multi bagger समझी क्या, ऐसा नहीं होता है. So I think that's what
Right.
the viewers need to keep in mind, and that's the messaging which Samir is trying to give us right now. So we heard over the last 15-20 minutes, we heard about compounding, patience, discipline as a virtue. It's not made overnight. दाल मखनी को भी रात भर सेकना पड़ता है for you to have a nice experience at Sheetal Bukhara or ITC, wherever you go. Rajesh, the question to you is, in this compounding journey, in this return generation journey, where does risk really fall in, and how does risk, form a part of the money manager's entire process?
Well, I think that's really very interesting question, and I completely agree with what Bharat Bhai and Samir Bhai said. And they both were, once upon a time I was serving them as my clients on InstaDesk. But superior risk-adjusted returns is something which is very, very critical. Protect capital and then create wealth. Because if you lose capital itself, then the wealth creation on the lower denominator will final destination you will not able to achieve. So the risk management is an integral part of portfolio construction. So if I meet investors, say in 1990s when we used to meet investors, the expectations were 3% per month. Per month में बातें होती थी, per year में बातें नहीं होती थी. In 2009 when I started on my own, the most investors, they are talking about 2% per month. So 36% थे 24% पे आ गए. And last 2 years in this COVID era, everybody has made money. So now people are looking at times, the mentality has now become more traders mentality, because whatever you bought went up. So I think very important is that what is the downside? What if I go wrong? And as Benjamin Graham is rightly put, the biggest enemy of investor is investor himself. So you need to keep asking question to your underlying thesis. Then what if I go wrong? And that's the reason why, at least what we follow, what I follow, is a very disciplined exit strategy. So what to buy, probably many of us know what to buy, but when to exit out of it? And that's where we have a very systematic business cycle approach. Because remember one thing, 75% of Sensex has changed in last 16 years. The railroads, which was 30% of Dow Jones in 1900, today it is probably 0% of Dow Jones. So the only constant is change. And the world has become more volatile. The business cycles have become more volatile. And as Samirji was rightly saying, that earlier the management, when they were talking with us, they were giving us 5-10 years view, vision. And now they meet, they say, let's talk about 3 years. And we cross the bridge as it comes. So there are a number of factors which are influencing the business cycles. They are becoming more complex. And I commonly use that word VUCA world, volatility, uncertainty, complexity, and ambiguity. And in that VUCA world, you need to make sure that what are the points at which you will review your investment decision. What are the points at which you think the business is not going to deliver what you thought initially? So it is not like, at least at my side, I don't buy the thing thinking that it's going to be 10-year story. Of course, we'll hold the company for 10 years if they deliver what we think they should for 10 years. But if they don't, due to internal or external reasons, don't get sticky to it. Get out of the boat and find another company, because India is a land of opportunities. And there are 500 companies which makes 100 crores plus profit. So yes, there is a good canvas of opportunity, and you can do pick and choose and follow a systematic superior risk-adjusted return policy. That's ultimately the mantra for a long-term wealth creation in my view.
So Rajesh, everyone know that. Sorry, Bharat Bhai, tell me.
I would say typically what Rajesh was talking about, controlling risk. And I would just say that risk is usually underrated. and returns are overrated in the eyes of most people, including money managers.
Yeah.
And that's because all Homo sapiens love the tangibility of a number, while intangibility of something like a risk appears probably remote or not palpable. But I think risk is the real thing. Returns are an outcome of it, is to how you manage and the skills of being able to choose well. And therefore, uh, real returns are actually the gross returns, which is stated on the fact sheet, minus the risk, which is difficult to define, but is definitely there. And therefore, sustainable long-term real returns are a subtraction of that risk, but not easily appreciated.
So absolutely. In fact, well, I tell this to my team very often, and I share this with investors also. Risk is the most forgotten four-letter word in good times. अच्छे time में किसी को risk याद नहीं आते. I think that's very, very well articulated by you, Rajesh. And you mentioned this word about mantra, and I resonate with that.
And
You said mantra.
if you ignore that four-letter word in the good times, four-letter word hits you in the bad times in a direct way.
Perfectly. Well said on a Saturday afternoon pre-lunch session. Superb. Absolutely agree with you. But in this mantra, towards long-term, wealth creation journey, in your experience, Rajesh, what have been the pitfalls or the mistakes which you've seen investors commit? Just quickly, one or two points which you can highlight.
I think a very important thing is take a measured approach. So at times I have seen many investors globally and locally, both, they love the story. They love okay, this is a great idea and this is going to be probably 10 times, 20 times, or may not be measurement, but yes, I love this company, and make a disproportionate weightage. And suppose something goes wrong. And let me give you one example. The Volkswagen Global, number one Fortune 100 company in automobile in the world, but one auto emission norm scam.
Yeah.
And stock was down 40-50%. Or for that matter, the Indian pharma companies and one US FDA import alert is enough for stock to go down 40-50%. Now the question is, can you predict the auto emission norm scam? Can you predict the US FDA import alert? And at least I don't think we can. Nobody can control such events. So do not take a disproportionate weightage and make it a measured approach. And that's a very easy way. While in that process, you might feel in hindsight that if I would have, say, 10% of my portfolio, today I would have become a billionaire. But what if it would have gone wrong? Correct? So I think very important, if you ask me, the remedy, the easy remedy is take a measured approach, take it one step at a time, and then you keep seeing how the company is delivering and keep that greed under control. I think very important is greed and fear. And in that pendulum, it's very important to greed, control the greed and make sure that your emotions do not come in out, when you're building the portfolio construction. And as you rightly said, the four-letter word, it all comes to that what kind of risk I'm willing to take and what kind of downside I'm willing to take. And I always tell investor, please write it on a paper that, so when you meet investor, they say, I have a 10 years view. And the market goes down 30%, they call, boss, kya lag raha hai bazaar? So please write down on a paper, that, okay, I'm going to hold this investment, any product, say about 10 years, and I'm ready to lose 30% of my capital if market goes down tomorrow. Do you have that kind of a patience? And if it is not, then probably equity is not meant for you,
Yeah.
So I think it's all about the human psychology, learn over a period of time, develop over a period of time, and build your risk capabilities to make sure that you participate in the compounding journey, which we all are talking about.
Just a small point, Lakshmi. Risk perhaps doesn't lie in markets. It probably resides in your own mind.
Absolutely. Well said. Yeah, it is in your mind, and it is very, very subjective. The ability, risk. See, food to you is poison to me. So obviously, the risk-taking ability of each individual is different. So yes, it sits in the mind. But the important takeaway here is do not undermine the role of risk when it is, the process of portfolio and returns generation. I think that's exceedingly important. Talking about all achievements, here we have, as I said, all three of you, the kings who created the Midas touch. Samir, if from the king, if I make you don the hat of a doctor, and if you do a post-mortem of your past processes, everything, all of that, any regrets that you think you had, and you can share that, and then that probably helped you do something better after that?
There have been many regrets if I look at it like that, but the whole idea was to minimize regret. So
Yeah.
actually, even though now we run a hedge fund and we think we have this great ability to find baggers and multi-baggers, the broad thumb rule has been that for these new emerging ideas that we have, not the old steady sort of compounder type, that we don't want any one stock to make us lose our sleep.
Right.
So our starting positions are only 2.5% per name in 15, 20 names. And the other 50, 60% are in the more sort of already discovered, only choosing stocks. For example, today, if somebody owns an HDFC bank like we do, we can't say we are discovering this stock, which is supposed to be the part job of a fund manager, but we are choosing this stock from a universe of whatever 50, 60 large names. So from the stocks that we are choosing, we will have maybe 5-ish per name. But I have had many stocks that have gone down 50, 60% in a month or in a year.
Right.
But broadly, at the end of the year, the other side, or even you should not notice that actually it had gone down 50% because you lost, say, 100 basis points or something once in a while. But that has happened many times. And that has been the lesson which has made our consistency higher. That this idea that if I don't have a 10% position in a stock that is going up, then it makes no impact to my portfolio. It basically makes you feel as if he knew that it is going up 100 times. The point is, you bought 50 stocks and 4 of them went up that much and 5 went up some 10 times and the others broke even and 5, 10 went down. That is how it is. For example, people say that we buy companies which have good managements.
Right.
Now and when do you know that it is a good management? So, for example, Kotak became a bank in 2003.
Right.
So, how would you know in 2003 it has good management? It was not even, it was a broker before, and who respected any brokers? So that means you will have to wait till when? 1 year, 2 years, or 10 years to say it has good management. Are you not supposed to see a whole cycle of ups and downs? And so, for example, Bajaj Finance in 2008 did quite badly in their lending business. So at what point would you say they have good management? Just because they hire some guy from Citibank or Aditya Puri comes from Malaysia, does that make it good management? So therefore, the idea is that you bet small on the basis that they are not bad managements.
No.
And you're giving them benefit of doubt to become good managements. Otherwise, every stock you have to wait 10 years to be credibly able to say that I buy only good managements, because you can't say in 1 year it has good management unless it has gone through a cycle, unless it has had some stress where it came out whether they are good management or not. Because in the beginning, everybody's good management. Then there is some crisis and they become bad management.
I'll just say that not
some
to
compromises.
I'll just say that not to that, but while what Samir said, that whether it is a good management or not is something that you unplug over a period of time without any doubt. I mean, it's not a plug and play that you put it into the plug and light comes out and you know it is a good or a bad management. But certainly bad managements are known, and avoiding the bad management is a
big
very
part.
important duty.
True.
Absolutely. That is the whole point. That it should not be bad management. Whether it is good or not, you will discover with time. But you don't go in a bad management knowing it's bad because it is cheap or because today they have done something or tomorrow a private equity or somebody is coming in. That is exactly the point.
It is like having samosas versus air fried samosas. दोनों में आलू है, दोनों में मैदा है. इसमें तेल ज़्यादा है. I think that's very important. So I completely buy your
I
point.
think Lakshmi's staple diet is movies and food.
And good thing is she knows Hindi well.
You know, Bharat bhai, my LinkedIn profile says food, film, and finance, or finance, food, and film in that order. Finance is my bread and butter. Mr. Kotak pays me my salary for
Finance gives you the food.
finance gives me, and films motivate me to do more of finance linking in. But the final question to you, Bharat bhai, since we are running out of time, you articulated the investment framework very beautifully. Quickly, just 2 or 3 points on the behavioral framework that will aid a richer, happier, and a general investor. So, anything on that front?
Yeah, I think that is a very important question, and I guess answer may vary from each individual. But for me, I think investing is a joy as far as I'm concerned. It is not merely work. It is not a profession. Uh, the fact that good investing will lead to riches and build wealth, important in itself, but that still is a byproduct. I think pursuing the passion of investing in itself is an undiluted joy.
Right.
The knowledge that it allows you to accumulate and incrementally keep adding to yourself itself is hard to define its worth. That itself is an objective in itself, which explains everything that you want to do about investing, irrespective of other things which is being there.
Right.
I think the passion that allows investing to be what it is again very vital. Investing is not a 9 to 5 work. And if you come to that with that perspective, I think you shouldn't be in that area. It is the sheer enjoyment it provides, and therefore you need to have a passion for it. Without that, it becomes a work and drudgery. Also, it may sound a bit socialistic, or it may look a little, so to say, exaggerated, but I believe in it. I think, in some sense, I believe good investing is a social duty that you discharge. Not, as I mentioned right at the beginning, there are a lot of people who are good at creating income, and then there are people who are good at creating wealth, but very, very few have capability to create wealth out of wealth, or more difficult to create wealth out of income. And therefore, investing is a specialized activity. Hundreds of trillions of dollars of money globally is managed by not even 1 million people. I mean, when you look at the size of the industry and very small number of people which works in that industry, makes you realize it's not a specialized, it's a very specialized activity, no matter what you say. And to that extent, doing it well, doing it with panache, doing it with intensity, and as a trusteeship responsibility for people who depend upon you to do it well.
Yeah.
I think that to me is a very worthwhile objective in itself. So, if I have to kind of sum it up, getting richer is a kind of a very primal instinct, or a very basic level of objective. Important, but I would say it's a primal instinct. Getting wiser is a state of being. It still is a tool, it enables. But objective, I think, truly is to be happy, to be enjoying it, to really get that gratification which good investing provides, the satisfaction that it gives you, the knowledge it allows you to be exposed to. And incidentally, it does allow you to make money and be wealthy But I would still treat that as a byproduct. I mean, the joy of doing it, the passion of doing it, and the other aspects, to me, that remains the ultimate adrenaline of what investing is about, the happiness that it leads to.
Correct. No, absolutely true. So if I were to, summarize today's session, I don't want to use flowery jargons, but I just want to say if Midas were an acronym, because that is the core topic that we discussed and debated about. M stands for meticulous, being meticulous, not magical. I actually stands for the intensity of your ideology. D is the discipline that holds conviction for you to, chug along even in not so good times. A is for articulation of this entire process into your investment journey. And finally, S stands for success, which is the final outcome, which Bharat Bhai rightly summed up. And if I wear my Shairi hat, this is the summary of what I wanted to share with you today. But ये Midas touch नहीं आसा, बस इतना समझ लीजिए, ये investment का दरिया है, डूब के नहीं जाना है. So on that note, thank you so much. You guys were a wonderful panel. And over to you, Aishwarya.
Thank
you very much.